for joining, and I'm hoping we've now got the guys online. So perhaps one for you, Marcus and Greg. One of the things that we find with global small caps is a lack of understanding of what's the actual size of the companies in that universe and that you're investing in, and how does that compare to Australian equities? Are we talking global small caps being of similar market cap to, say, Aussie mid caps? What are the size of companies?
Okay, it's a good question. We like a small cap in Australia, like the top 100 goes up to about $3 billion. So anything from a $500 million to a $3 billion Aussie would be roughly a small cap range in Australia. And globally, we use a MSCI World Small Cap Index as our benchmark. The median stock in that is about 3.5 to 4 billion Aussie. So like the upper end of a sort of small cap in Australia, and looks more like a mid cap, probably more like a mid cap name in Australia. So our fund's got 45 stocks in it, and the median cap's about 5 billion Aussie. So it gives you some kind of sense. It's bigger than Australia, but we're not talking massive companies, and then well smaller than the names people know about in the really large funds.
And maybe, Greg, for you, the universe of companies you're looking at, and how are you filtering those and getting rid of the rubbish to focus on those that are of interest to you from a research and portfolio perspective?
Global Smalls is enormous. It's almost 5,000 companies, and we're meeting that universe roughly every 10 years, give or take. So I think that is very different from large cap, which is much more of a coverage model. You can meet everybody every year and just keep cycling the universe and trying to find what's changed at a micro level. Whereas a lot more of our responsibility in small cap is hunting to understand and build relationships and local context in 23 different countries. So, for us, we don't actually screen on output, valuation, growth, returns. Those are all things that we will assess as a team, but we will screen on size, sector, region, and liquidity, because we don't want to waste time in opportunities that aren't scalable, or companies that aren't liquid, or companies that frankly aren't small cap. One of the things that Marcus touched on, which I think is important, is anything X mega in global is being bucketed into now small. So we run into these SMID funds that have $40 billion companies in them. It's really, I know why they're doing it. It's a great business decision, but I'm just not sure that that's actually true to label small cap. So I think there's a lot of buyer beware in this asset class, and we're trying to stick to what's on the tin.
Yep. I might throw it around so we make sure we get coverage of both of the asset classes. But John, Ashish, in emerging markets, what we found here in Australia with the emerging market funds is really the outperformance of the benchmark, or even keeping track of the benchmark over the last probably 12 or so months, has really been quite a binary one, and that is whether you're overweight or underweight India. Firstly, do you agree with that? And what's the China. What's the view on China going forward? And of course, India's been the complete opposite and performed very well.
I might kick it off, but yeah, look, we've had the same concentration of returns issue in EM as we have in most markets, and that's been India and tech hardware outperforming. In terms of where we are with China, our view is that it's the consensus view is that the macro is very tough, but in these points in the cycle, it usually creates some opportunity. China's a very deep market. There are very resilient businesses that have got very attractive return on capital, very high growth. They're increasing shareholder returns through dividends and buybacks. That's been a very consistent theme that's been playing out. And many of these companies are very domestic focused, exposed to structural growth drivers like localization or something that's benefiting of a policy tailwind. And those stocks are very cheap in this sort of market. So we're actually seeing a lot of opportunity selectively in China amongst those opportunities. And really the catalyst will be, when does housing, the million-dollar question being, when do house prices bottom? And in the last couple of months, we've had a shift in policy to focus on destocking inventory. So we think that's a huge catalyst that could bring that bottom in house prices forward.
Yeah. Ashish, your view?
From time to time, you have these countries, certain countries do very well and certain countries don't. So I think, so just to call, beforehand, which country might outperform over next 12 to 18 months or even 2 years is actually very, very difficult. I think instead we try to do is we basically trying to spot well-proven entrepreneurs or family-owned businesses where kind of have a very proven track record of creating wealth over time, and try to stick with them, and then almost partner with them for long term, and invest on that basis. So that's really we try to do. So I mean, yes. So I mean, I sort of agree with John's view that China is actually presents a lot of opportunities. China has close to 4,000 to 5,000 companies listed on this stock market. From given our, I mean, Aikya's investment approach, probably less than 1% will pass the test. So not even, let's say, 20 companies would be on our quality list, but there's still 20 companies. They're not zero, so we have plenty of opportunities, and those companies we think are almost now as attractive on valuation as they ever been. So it's actually quite interesting time. I mean, I think China is one of those cases where kind of, evokes very extreme reaction with the investors. So when market is doing well, as it was in 2016, 17, or before that, 2010, 11, people used to love China and ignore all the governance issues, and Communist Party still ruled China back then. So, but now the China is not doing well. So people kind of bring in all the issues around, Communist Party, rule of law, and so on. So it's not, we don't think it's changed in a significant way over the last 15 years. It was always a very difficult place to find good companies. It's still a very difficult place to find good companies, but it's not zero. You can still find some good companies there. And as John said, market is quite deep.
Okay, follow-up question, quick questions, quick answers, given that we're trying to catch up a little bit. Your view on, I mean, one of your competitors that's pretty well documented has what is a developed market stock in the portfolio. It happens to be NVIDIA, with the argument that a lot of the revenue from NVIDIA comes from emerging markets. So what's your view on what stocks should and shouldn't be allowed in emerging markets portfolio?
What we have to do as active fund managers is provide investors essentially what we claim to provide. I think that's really important to just stick to what we are about. So the approach, at least we follow, is that emerging markets, firstly, why is someone bothering with emerging markets, right? I mean, you just, as a global equity investor, why do you bother? You essentially, in our view, bother for two reasons, because these markets are almost 80% of world's population, and I think most of the incremental economic growth is coming from these markets. So these markets actually provide you with very strong long-term structural growth in terms of consumption and whatever is associated with that, infrastructure build out and so on. So you're essentially investing and finding companies which are exposed to that, and therefore investing behind those companies. And most of those companies come from the local economies, because those entrepreneurs are quick to realize the business potential, and then they build businesses around that. The second we think is the opportunity in these markets are the fact that 80% of the world population lives there, so which means that they're going to throw up quite interesting entrepreneurs locally, and once they win their local countries, they will go out and then build businesses globally competitive. So you're essentially trying to kind of make sure that you capture both. So you have companies like Taiwan Semiconductors, or you will have companies like Tata Consulting Services out of India, which are globally competitive businesses, have global businesses, but they have base, and the competitive advantage comes from their local country. I mean, TCS is successful because they've got a low cost India base, and that's really why we think it's an emerging market company. While on the other side, you have Marico, which is the Indian local business catering to Indian consumers. So those are the two types of businesses we think emerging market funds should have. Now, NVIDIA, or I mean, you can justify any company, Google, or whatnot, whatever is working today on the basis that it cater to emerging markets, because ultimately 80% of the world population is in these markets. Pretty much every major company will cater to these markets, but we don't think it's true to the label.
Yep. Global small caps, Marcus, Greg. We talked about potentially reaching peak rates, inflation being brought more back under control, but with that tends to suggest sort of perhaps slowing economies as well. How do you view the performance of small caps in an environment like that?
Well, I'm sure Greg will have a pretty similar answer to me on this one. Look, you never ask a barber if you should do a haircut, get a haircut, because barber's answer will always be yes. And I think you never ask a small cap manager if it's time to buy small caps, because the answer is typically yes. Having said that, small caps have lagged large caps for sort of 2 years now, both internationally and domestically.
Yep.
So I think a lot of that sensitivity of the economy has been reflected in share prices. And also companies respond, right? So if there's a slowing economy, companies will cut costs, rein things in to try to preserve earnings and margins, and that's been going on globally and domestically. So I think rates look to be peaking. I know some of our colleagues think that inflation's got a long way to run. We think inflation's peaking out, and so rates are likely to be stable, potentially being cut. And I think that's probably a good time to be looking for global smalls, especially with the valuation anomaly we're seeing vis-a-vis large caps.
Maybe I'll pivot that question quickly, Greg. What are the sort of companies that you're looking for in the environment going forward?
I actually am going to give 3 because we're trying to do more with less here in time. But I think the whole concept of a no excuses portfolio is critical, because there's been so much time wasted on that. The answer to that question, is this the time for small cap? Was yesterday the time for small cap? Did small cap bottom in 2022 or 2012? Like, it's totally the wrong question in our view. I think your job as an investment professional is to deliver value over a reasonable time frame, and you control what you can control. And so, for us, the best example was financials over the last year. We had, regional banking crisis, rising interest rates. It went from 17% of our fund to 35% of our fund almost during that time. And it ended up delivering about 60% of the alpha over the last 12 months to April. So you're supposed to invest when the headlines aren't great and everybody's scared, and you're supposed to sell when everybody's excited and there's no more room on the bus. And so the financials that delivered that value for us, Hypoport, Burford, Esquire, these are, a regional bank, a mortgage software business in Germany, and the world's largest litigation funder. They're not Visa, they're not MasterCard, they're not household names, but they delivered a very resilient and uncorrelated portfolio during what was otherwise a high excuse period for a lot of investors.
Well, time is up, so thank you very much.
Roddy and our panelists.